Jeb's got the listings lined up in a row. Josh brings the numbers, making dreams grow. First-time buyers stepping through the door. Keys to your castle, they're what we're here for. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new land. Navigating through the home buyer's maze. Educated steps in a world full of haze. The podcast is rolling with wisdom to share, helping you settle in your new lair. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine. Down, the numbers make sense. Jeb shows the vision beyond the white fence. Teamwork like this is rare to find, helping you leave all your doubts behind. They talk about homes and talk about life, cutting through the stress and the buyer's strife. With every word they light up the spark, guiding you through when the road feels dark. Jeb and Josh, they're paving the way. Dreams to reality, they make it day. From the first hello to the closing sign, your journey to home is looking divine.
Happy Wednesday. Welcome, Josh, to another week of the Educated Homebuyer Live. How are you this evening, my friend?
I'm doing great. Doing fantastic because the song just elevates it.
The song just elevates the mood, doesn't it? Kind of just gets things going. You know what's great is that when you've got an offer out on a property and then the agent calls you as the song's going through right now and wants to discuss the offer because he's about to meet with the clients. And then we go live and I'm like, you know what? I'm reading the voicemail. I'm like, this isn't the right time. This is not the time.
It's poor timing. It's poor timing.
Very poor timing on his part. But, we'll just say a prayer. You guys out there, say a prayer for my clients that we get the offer accepted, that he gets what he needs so that we can, be a better show than what's already going to happen this evening. Big news from last week, Josh. We got CPI this Tuesday. A little bit of mixed results, right? We had headline CPI come in a little bit lower than expectations, and then core CPI come in a little bit higher than expectations when you're looking at the rounding numbers year over year. Month over month, we're right in line with what we wanted to see. Some of the underlying factors played into parts, but I guess into how these things were portrayed. And at the end of the day, the market didn't see it as a big problem. And because of that, we've seen rates continue to just kind of settle, I think was what probably the best word. And probably the best thing for us, right, is that we're not seeing that volatility in the market right now.
Yeah, we had after a big drop with the jobs numbers and then kind of inch sideways for a few days and then gave back a little bit of those gains. And CPI, I think it was a sort of preemptive selling ahead of CPI. And CPI convinced everyone that for now, this horrible tariff inflation boogeyman is not what everyone has feared.
Well, tonight we're going to talk about the most undervalued housing markets right now in the housing market with a study done by Moody's. But before we do that, Josh and I were talking prior to the show. Josh is a fantasy football fanatic. He's got GPT spreadsheets. He's got custom GPTs. He loses money every year. This guy
make money every year, brother. Every year.
He is
thousands.
Losing time. He's losing money by wasting time
by the hour
on fantasy football. So my question to anybody watching right now, are you a fantasy football fanatic? Are you somebody that loves fantasy football? You play every year. You're in multiple groups, maybe just one group. That's a one. And do you kind of like me, don't despise it, but think it's a complete waste of time? Number two. So give me a 1 or 2 in the chat while we're going over charts and we'll see where we are, Josh. I think our audience is going to lean more towards you in this than me. but it's it is what it is.
And if you hate it, if you hate fantasy football, give us the longest like rant you can about why fantasy football is
It's a waste of time.
in the comments.
It is. I like the idea. I think the idea is fantastic, but the fact that you got to make trade, like you got to do everything, and if you miss something, you're screwed. Like your season's done. Like just
be detailed, stay on top of things, be focused.
I'm trying to create content, Josh, so that we can continue to have a business here.
Okay.
With that said, guys, we're going to jump into charts as we always do, and we're going to start by looking at those undervalued markets, Josh. So this came out in Moody's. Lance over at Resi Club took the data, put it on a map, helped us decipher what we're looking at here. So we're actually going to look at the cities next. But when you look at this chart here, I'm going to ask the audience, do you see anything that looks a little abnormal? Any areas that you think
unexpected?
Yeah, I cannot believe that market would be undervalued. I think there's probably 5 to 10 up here, if not more. But I'm going to spoil it, Josh. It's saying at the moment that the San Francisco market, the Bay Area market, is the most undervalued in the United States. What are your thoughts on that?
One of the markets that is struggling, one of a handful of markets that you could legitimately say over the last 12 months has struggled. It's a very interesting approach that they take. If you look, Seattle is also a very light color up there. Seattle is heavily appreciated. Their Moody's methodology is a little bit funny. I had told you, hey, check out this article because the overall premise of it I thought was interesting. But then you look at the individual map and you're like, this is bonkers. Because really what they are looking at, and we've talked about this a lot on the show, it's income to historical home prices. So incomes in the Bay Area, in Seattle, where you've got Google, Amazon, all of these companies that have very high salaries. Well, apparently homes are not high priced relative to that, even though those are two very high priced markets. The whole premise of the article was that in 2022, Moody's said the market was 28, the national market, which we're very careful to not talk about the national market, but nationally homes were overpriced, overvalued by 28%. And now they're only about 8% overvalued. And really the key takeaway there is that incomes have increased through that time. Home prices have stayed flat. We've seen a little bit of improvement in interest rates, aka affordability. It's just Moody's has a funny way of measuring.
And I think the important takeaway from this is to not get caught up in the headlines of somebody saying a market's overvalued, right? Understand the market dynamics, the local area that you're looking in. Because if you just went off this list, chances are you're buying in areas that are not undervalued by any means. In fact, probably overvalued to some degree. But you got to understand the methodology and how they come up with this stuff, as that will kind of, help dictate how you approach it. So those are the markets rather that you can see there. If you're listening on the podcast on, Apple or Spotify or what have you, starts with the Bay Area. We go into Florida. We're in, again, up in Northern California, Chico, I think it says there, San Jose. You're in Texas, Oregon, California, Louisiana, Illinois, Arkansas. Like a lot of these areas, like Louisiana, we know is getting hit hard. I mean, Florida's on this list. Like, what are we talking about here, Josh? So anyhow, take it with a grain of salt.
A bunch of them, 5 or 6 of these are cities in Louisiana, which Zillow just last week is out with their report saying that Louisiana is the most likely to experience big drops in home prices or larger drops in home prices. So pick your expert and they'll tell you what you would like to hear.
There you go. So let's talk about national inventory, something we look at every week. Again, local market data is more important than national, but we like to look at national. We actually had a dip last week, Josh. We went from 865,000 homes down to 859,000 homes. Is this the peak in inventory? Very difficult to say at the moment. I think there's the potential for it unless rates move lower, but we will see, right? We're 24% more inventory than the same time last year. Parts of this year, we were up 31, 32, 33% more inventory. So that number, that gap is coming in closer, right? Not so wide now. And it's because of, looking year over year, how things just happen with seasonality. We always like to look at Huntington Beach and Orange County. So Huntington Beach, or Orange County rather, actually dropped 0.66%, sitting down at 4,976 homes. Huntington Beach stayed flat at 305 homes. Again, it's hard to say right now whether that's the peak in inventory or just seeing an abnormal week, but we'll continue to watch it. new listings. This was a big drop week over week. I think it's something to pay attention to. The big thing here was what 66,000 single family homes compared to 75,000. We don't want to see a dip like this with new listings. But again, it's 1 week. We'll continue to watch it. I'm not going to bore you with, pending sales, weekly pending sales. Properties with price reductions still holding tight at just over 41%, closer to 42%. So not a lot to report there. And then we look at division of tariff cost coming in as of June, right? So Josh, you and I talked today on the podcast about how, Powell came out in June and said that, we haven't yet seen the tariff impacts, right? It's going to take a couple of months to come in. And now he's still saying it's going to take a couple of months to come in. So this is what it looked like going back into June.
Yeah, and this is private. The reason why there's no attribution to this, it was a gentleman who posted it on X, and it was their proprietary data of some research. So take it with a grain of salt. But they're saying that tariff costs, 64% are getting eaten by U.S. businesses, 14% are getting eaten by the foreign exporters that are sending things over here, and 22% so far by U.S. consumers. So take the next piece with a grain of salt, depending on your political bent. His feeling is that tariffs are always a tax on labor because these businesses cannot continue to absorb this. So if they can't pass it on to the consumers, they're not going to continue giving pay increases and benefits to their workers. But anyway, you cut it. Goods, we're going to see here, like here in this next chart here, this shows where we're seeing tariff-based inflation so far, and it's almost all in goods. So goods is a small portion of the economy. Some of these are more impacted than others, and this is why what we're saying is you're seeing a much smaller impact than many had feared, and it's in a much smaller area of the economy than expected. So it's going to be inflationary. You're seeing some of that, but so far, not a huge impact, and I would be surprised if there is a huge impact. And a year from now, hopefully we can finally get to some normalization where we don't have this tariff impact, all of the other things, and we can get to some normalization in terms of what we're looking at. So you at the top of the show, Jeb, kind of went through inflation, what we were looking at. We were 2.7% on the year over year, 0.2% month over month. So both of those were about the same or better than expected. So not a whole lot of news here, but the core rate is what is kind of more important. It strips out food and energy. So core was expected at 3, went up 3.1 year over year. The month over month was in line, but again, the internals there, goods inflation is showing up there. And what we had been really suffering from through 2022, 2023, when inflation was really high, was service-based inflation. So now you're seeing service-based inflation come down largely because shelter is lumped as a service, and you're seeing goods-based inflation. So it's interesting and worth watching. But if we look here, again, this is the Cleveland Fed, their nowcast. Looking at next month, they're seeing another 0.3, a 0.25 on the core. So very similar to this month. If we look at what's falling off, we're not going to see much improvement. And as you can see from the market reaction, the market is just taking it with a grain of salt. Like, yeah, it's base year effects. It's what we're seeing. And everyone would like those numbers to come down. But until the tariffs really start filtering through, you're not much going to see that. We like to look at the Truflation Index just because it's picking up more real time. And it has, again, started that trend down back at 184. A month ago, it was 174. We'd made a little run up. I think it was over 2 at one point, Jeb, but still showing things well in check and 0.9% below what the Bureau of Labor Statistics is reporting in their CPI figure. So what is the market doing with this? We are now at 100% chance of a Fed cut in September. And you're like, Josh, that's not what it says. It says 95.8. 95.8% chance of a quarter cut, 4.2% chance of a half cut, a 0 chance of no cut at all. We're looking at for the October meeting a 65% chance of another cut if we don't get a 50 basis point cut, and then over almost a 60% chance of another cut there in December. So right now the market is thinking 3, but until we see like that certainty where you get those up in that 85, 95% level, there's still more for the market to price in and when we say the market, treasuries and mortgage-backed securities. Thought this was interesting just to take a look at. Jeb, poly market is a little bit less bullish, 7% chance of a 50 basis point cut, 80% chance of 25. So 87% chance, 13% chance of no change. So I thought that was interesting that people would actually wager their money at poly market, kind of like fantasy football, Jeb, but they do it with economic stuff. They're not seeing that. So I wanted to show the chart here a couple of different ways. The two teal, aqua, blue lines coming there together. We've got a falling trend line and a rising trend line forming a wedge there. We had broken out the bottom of the wedge and then worked our way back into it. And as of today, back out of the bottom. Probably more importantly, what we're looking at, you can draw these support and resistance lines multiple different ways, but we've kind of been in the middle of that range there until we break out under 420. And even at that, you've got pretty strong resistance again at 413. Till we break through that 420, we're not likely to see much of a change. But Jeb, you've got a philosophy, you get a feeling, not a philosophy, you get a feeling on this chart. You're saying that's an ugly chart. You think we're getting weak PPI tomorrow, we're gonna have a nice drop?
I do. I don't like your chart. I don't like where you have trend lines drawn. I think they're in the wrong spots, but that's just me. Hey, to each his own. That's the one thing about trend lines and drawing these things. It's somewhat of an art, and not everybody does it the same. I wouldn't have drawn it like that, but either way, what I see tomorrow is PPI, something being disappointing in the data. I can't say that it's PPI, but what I'll tell you is PPI's the biggest chance of a mover tomorrow, which tells me, based on that chart, that to me looks like that is going down, which means an improvement in bonds, and it means a drop in the 10-year, which in theory means some impact on lower, or will have an impact and hopefully move rates lower. So
bigger picture, looking at this, mortgage rates down 0.25% over the last month, pretty much flat over the last day and the last week. What I thought was interesting here, we always show Mortgage News Daily. I like their numbers. I think they're pretty darn accurate. But I had a listener this week when we went to lock their rate. They were about an eighth higher. I think we're at 6.57 at that point in time, and their rate was 6.625. They said, well, I watched Mortgage News Daily. I was expecting this would be 6.5. I said, well, 6.57 is not 6.5. And you also notice we don't have loan level price adjustments in here. Doesn't account for your loan to value, doesn't account for your credit score. It's giving you an indication. So just be careful. I wanted to throw this in here. So Mortgage News Daily is reporting 653. Housing Wire uses data from Poly, just another source that lenders use for locking interest rates and managing their secondary desks, 6.78. So a good bit higher. And then Optimal Blue, much closer to the Mortgage News Daily at 6.60. So just know all of these numbers are a good indication. Both Poly and Optimal Blue are real lock management tools that are being used by companies. Those are real locked interest rates. Mortgage News Daily, Matt watches the market very closely, watches lender rate sheets, and is picking up what we're seeing on wholesale rate sheets a little bit more. So that's why we like that one the best. But just beware, there is not one interest rate. And anytime you look at one interest rate, you have to see, hey, if you're putting 50% down and have an 800 credit score, you're probably going to be better than that. If you're putting 5% down and you have a 700 credit score, you may be a little bit worse.
Good stuff. And if you're out there waiting for rates to drop so that you can refinance, don't want to watch them every day, jebsmith.net/rate watch will get you on our rate watch list. And we can reach out to you and have that conversation to, figure out what your target rate is and update you as that becomes available. So again, on the screen there, if you have the ability to scan the QR code, if not, jebsmith.net/rate watch. So Mr. Lewis, you mentioned something there a moment ago that I think is worth discussing. It's not in the charts, but you mentioned LLPAs. You sent me a video today with Barry Habib, a friend of the show, and Scott. I mean, not Scott.
Besant.
Besant. There you go. Yeah, Besant. Was it Scott Besant? Anyhow, yeah. FHA.
Oh no, it was Pulte. It wasn't.
Pulte.
He's going to have.
Yeah,
he was talking about having Besant on.
Yeah.
But yeah, he was talking about Bill Pulte. With Bill Pulte.
Yeah, Pulte was on, director of FHFA director, and he mentioned some changes that are going to potentially happen in the lending world, some things that they're trying to get through. One of the things they mentioned was the credit score, the Vantage credit score that he's been working on, making that happen. So that has actually been something that's been implemented. It's going to come into effect at some point here in the future, and that's going to help more people qualify to get mortgages. But LLPAs are something that's been a complete pain for home buyers, what, going back 4-5 years now, Josh? I mean,
Early
well,
2023 is when the Biden administration completely overhauled them. And put your politics aside, anyone with a brain can understand for the last 50 years, the way LLPAs, last 40 years, the way LLPAs were handled, and then what the Biden administration decided to do with them. Prior to that, they are a measure of risk. So lower credit scores are higher risk, lower down payment, higher risk, investment property, higher risk, second home, slightly higher risk. All of those things, they have enough data that they can quantify fairly well what the risk is there. Biden administration says, I don't give a shit about risk. What do I think is fair and who should we be helping? So you have weird things in there. Second homes are priced awfully. Investment properties got much more expensive. People with the best scores and the biggest down payments paid slightly more than they did before. There was some misinformation out there. We had to do a whole episode on it, Jeb, that they were paying more than people with smaller down payments and bad credit, which is not true. But for those people to pay less, the people that were most qualified had to pay more. So from that perspective, all we're trying to do is get back to some sanity here where they can go back, do the analysis on the years and years of data they have and actually price risk with loan level price adjustments versus social justice.
And what can happen there is if that happens, the LLPAs get readjusted. That means you could, in theory, get a better interest rate without interest rate actually declining to some degree, right? So you could have a better rate, even if the market stayed where it is today, if those adjustments actually come into effect, which based on that conversation sounds like it's going to happen, just a matter, how long or when's it actually going to come into effect. So anyway, at the beginning of the show, I asked for you guys to do a survey. Nobody actually,
John Doe was the only one that
Thomas was the only one that came in and he got Josh's side. So I say that the survey doesn't count, and that was a bust. So,
well, no, it's 1-to-1 because John Doe also piped in and said he wasn't athletic and he never liked watching sports and he doesn't care about your stupid fantasy football. He only likes Clippy, the clip art guy from Windows 94.
Fair enough. All right. So do we actually have any questions in here that are housing related?
I don't believe we do. I think we bored people by talking about the most undervalued housing market in the Bay Area and Seattle, where you can go and find cheap homes.
I guess so. And therefore there's no actual questions here on real estate. Wesley, we already know Wesley is definitely a fantasy footballer. So
one, if you are pro fantasy football. Two, if you are anti fantasy football, and there is no in between.
You just think it's a waste of time.
There's no in between. Haters are two.
Listen,
haters are two.
If you like
ballers are one.
I say it's okay, but I don't like it. I just think it's a waste of time. Anyhow.
It confuses Jeb. He's not good with numbers.
Numbers, I don't understand them. Anyhow, there we go. All right. So, Josh, what do we do for the next 38 minutes?
We've answered all the questions, and you have clearly biased the audience because now we got Wesley and Willing chiming in together that they're both throwing up twos here. So
listen,
I don't know.
It's just people that value their time over wasting it. That's it, Josh. That's what we've decided, and that's where we are. Okay, so let's see here.
Here we're gonna make a message here. Tom Collins says, just because I don't understand any of the data y'all provide doesn't mean I'm not interested. Hey, I am quite positive that I was supposed to reply to you earlier this week so we could get something on the schedule because last weekend got busy while you were looking at homes. So please, once we get off here, I'm going to make a note to go back and look at our last email and see what I owe you.
Josh, that's the second time 2 weeks in a row where somebody's reminded you of something you didn't.
No, because Greg piped in and said, no, you got me what I needed. This is another new thing I need.
This is a problem, Josh.
Hit a new need above and beyond what we had already fulfilled.
All right, here we go. So we're going to say, we're going to answer Platinum Black's question. It says, what's roughly the mortgage amount at which a large conventional loan becomes more expensive than a small jumbo loan? Josh?
For most borrowers, the jumbo loan is always going to be more affordable if you can qualify for it. So, mortgage insurance with a lot of mortgage insurance companies don't insure jumbo loans. So let's say if you have 20% down and a really good credit score, and you're above the conforming limits for your area. Some areas, if they have high balance, like Orange County and LA County, you can go to what's the crazy number? 1,209,750 is the number now. So from that perspective, some you have to be above that, but most jumbo lenders just have to be above the standard balance limit, which is 8,065. So if you're higher than 8,065, you're putting 20% down, you have a good credit score and can sort of thread the needle on the jumbo, you're almost always going to get a better rate on that jumbo. During like COVID times, it was significantly better. Now it's slightly better.
And what I'll tell you is this does not help Josh at all. But if you have a lot of money and you're doing a jumbo loan, there are banks out there where you can park your money at the bank. And that bank will give you pretty much the best type of interest rate out there in the market for leaving your money at that bank for an extended period of time. So there are some crazy things out there. I mean, you can get interest rates right now in the mid fives on some of this stuff on jumbo loans with doing that sort of thing.
I have an example right now. Borrower has 12 million liquid. He's not moving money. He talked to a couple different banks. Well, if you move this over here, if you move this, and he's like, well, why would I do that? I've been with my financial advisor for 25 years. I trust him. He does good things with my money, and I'm going to give it to a bank teller at Chase. I don't think so.
No, fair enough. Well, if you got 12 million liquid, I'm not sure you really, you're probably doing all right.
He's doing just fine.
Doing just fine. So let's see here. We got questions on my beard, Josh. I don't know. I mean, we're at that point in the show where there's not a lot of questions here, so we're going to answer it. Do I maintain my beard? I do not. I do nothing. I just go into a barber, once every couple of weeks, and occasionally I might let her trim it, and sometimes I don't. So I don't use product. It is what it is. And old school.
You said you went to a barber, and then you said her. You go to a beauty,
she's my barber.
You go to a beauty salon.
She's my barber, bro.
You go to a salon and get coiffed?
Go to a barber, bro.
Go to a salon. You clearly said there's no such thing as a female barber. Let's put up another poll.
Wow.
Is there such thing as a female barber?
You're about to get canceled. Canceled, right?
There's a hairstylist. I don't even know what they call them. They work out of salons, but they most certainly are not barbers.
You hear this guy? I mean, this could be a change in the show. I might need a new lender after this.
Okay.
Okay. Let's see. We got questions saying, are you guys seeing any activity or any signs of activity picking back up as rates inch down? So Josh is probably a better person to answer that because he deals with more people on refinancing buying side. But what I'll say before Josh answers is, the last couple of offers that I've put out have been multiple offer situations on the buyer side. So we're competing against other people. And on the selling side, I've got some properties that, like I just closed one today that had multiple offers initially. And I've got, one property that's been on the market 80 plus days. It's been in escrow now for the second time. We just put it back in, but that property's been sitting for a while. And I got one that came on the market today that like literally no calls yet. Am I worried? No, it hasn't been on the market 24 hours yet. But, if you were to go back a year, I would probably had 4 or 5 calls on it already. So it's just that changing of the guard, if you will. But Josh, what are you seeing?
Even I don't even know who the busiest loan officer in the world would be. One individual is still a very small sample size. We're pretty busy right now, a pretty full pipeline. But remember, when rates drop, we've been up like 15 to 20% the last 2 weeks in refinance volume. Not we personally, the industry. So loan officers have seen a big uptick in that activity. If you look at applications in terms of the MBA purchase index, I think we were up 2% last week, up 1% this week. It takes more time for a dip in rates to kind of filter into the purchase applications. And I don't even know the methodology of how they measure purchase applications. We've been, I wouldn't say busy, and I wouldn't say I've really seen an uptick, but we're also in August. It's kind of one of the lulls here. Once everyone gets back in school, another 4 to 6 weeks, we'll have a little bit of an uptick, just relative to this sort of end of summer doldrums. But it's been good, not great. And I wouldn't say anything that I could attribute to it because it's just such a small amount.
All right, good stuff. Dixieland says his daughter's a hairstylist, not a barber. There's a difference in the two.
There's
like
no such
my
thing.
barber
There's no
doesn't
such
cut
thing.
female's hair.
Your
Really. He only cuts
hairstylist,
hair.
your hairstylist cuts your hair.
Oh, Josh, you're showing your age here, bud. Showing that age. It's okay.
Well, Heather agrees with me too. She says, "Me too, Josh." Jeb
She
does
doesn't even
not.
know. So maybe she's talking about
She
fantasy
says,
football.
"Yeah, not true."
All right. So David says, my mother-in-law lives with us, health issues, thinking of solutions to remedy that, considering a DSCR loan that I can rent to her in a much cheaper market than we can follow. Better option, 75,000 available. So do you understand what's being asked here, Mr. Lewis?
A DSCR loan can work. 75,000. Hopefully that would at least be a 20% down payment. You can do DSCRs with less than 20%, but they just get difficult and expensive. The more you can put down, the better the DSCR ratio, the better the terms that you get. The other thing, David, just want to make sure we thought this through. If she lives with you because of health and you're going to put her in a cheaper market, is now she too far away to help, if that's really the issue there? Maybe it's a realtor question. Maybe we should be looking at buying a property with an ADU where she could be on site with you. Sounds like you might be trying to get away from mother-in-law.
Yeah, or maybe you use your 75K and you add on or build a she shed in the back and put her in the she shed
for your mother-in-law.
Yeah, there's potential there. J.K. Rawlings says, do you think, is this Harry Potter, Josh?
Yeah.
J.K. Rosser says, do you think there will be an uptick in people trying to buy land to build homes, tiny homes, in the next 3 or so years? So I don't know the answer to that question with buying land. I think most people, here's what I know, is that people don't understand what buying land actually entails. We've had the conversation many times here, Josh, on the show. In the last 48 hours, we've gotten 2 to 3 inquiries coming in through the podcast, through my channel, talking about buying land. So I think it's important here maybe to take this time, Josh, and talk what it looks like to buy land. Can you do it with a USDA loan? Can you do it with FHA? What does it look like?
Well, let's look at what the question behind the question, or what the person is thinking, because it's almost always someone from a much more affordable area, like let's say 200, 250, maybe 300 purchase price. And in those areas, that's generally the cost of the structure. So land is very, very cheap. You buy a piece of land for $10,000, $15,000, $25,000. And they go, okay, I can't come up with the 3% for 300,000. I couldn't afford that payment, but let me do this. I'm going to buy the lot, and 3% down on a $20,000 lot, $600. I can do that. Lenders are not going to loan you money on land that really has no functional value to them if they were to take it back without a substantial down payment. So you're generally looking at 20 to 40% down, depending on where you're at. The big players in this space are like community banks that are local to the area and are comfortable with that. There are construction loans that you're able to get, acquire the land and pay for building the home at the same time. But again, the people that are reaching out and asking about this are having a hard time getting into the existing home market. That is rarely a way to circumvent it and get to a lower price. So I don't ever want to be negative or tell people you can't do this or this isn't a possible solution, because you can go on YouTube and search and see people who have successfully done this. So I'm not saying it's not possible, but unless you're in construction, you have an in with someone that's going to help you get a manufactured home and kind of put it all together, it's just really not that simple. And maybe, maybe Christina has a resource for this, but I don't see this happening at scale really successfully anywhere. So do I think there's going to be an uptick in it? I think there's an uptick in interest. There's an uptick of people that are willing to say, hey, I would rather own a 400 square foot house that I'm going to live in by myself than continue renting. But there are some logistics and some difficulties. And generally the people that are successful with it are the ones that are able to save up, a chunk of money, buy the land, and then they build their tiny home on it. They're much more difficult to finance.
Well, let me go back to my question, Josh. Maybe make this quick because so we can move on to the next question. But USDA, FHA, any of these, are they actual options to buy land and then
no.
build a home?
No, not buying land and then building a home, buying and building, but that's not what these people are asking.
Sure,
They're always reaching out and saying, I want the land and then someday I'm going to get the home.
Sure.
So if you were to build a stick-built home, there are one-time close loans USDA, FHA, VA, conventional, where you can acquire the land and build. Many lenders don't like manufactured homes for that. It's kind of surprising to me. We've talked many times on the show. Manufactured homes can be really nice, and they can be like 30 days. It would be like a normal close. Like it's there in site, on site and installed. But many of our lenders that do the one-time close don't like manufactured.
All right. Question from Tom saying, have you a resource for prospective home buyers to use for looking up specific property tax rates by address to research particular areas by existing special assessments, blah, blah, blah. I don't know of a website that I guess like Redfin, some of the, here's the thing is like, depending on your state specific kind of, some states don't release that information. It's not public info. So you have that issue. Here in California, if you just go to the tax assessor's office, whichever county you're looking in, if you type an address, you can actually pull people's tax statements up. And on that tax statement, it'll show you the effective tax rate. So you can go about it that way. There are some, you know, as real estate agents, we have access to title and we can do certain things. But public wise, Josh, Redfin, some of these have tax rates on them.
So they don't put the tax rate, they put the assessed value. They go to land value, property value, total assessed value. So if I'm looking for a quick and dirty calculation, I always want to check for us here in California. You can't just look at what the current taxes are. You have to look at the tax rate. So take the taxes, the total taxes divided by the total assessed value, and it gives us a rough approximation. Because in California, lenders, unless we provide evidence otherwise, the underwriter is going to use 1 1/4. 1 1/4 can be too low. It can be too high. The standard property tax rate in California is 1%. So it's never below 1%, but then each city, community, area can vote on additional things. A builder can have the special assessment and voluntarily add that to get coverage for schools and fire and all that stuff. So for existing homes, you can generally go and look at that. Where it becomes a problem is if you're looking at a home that someone bought in 1982 for $73,000, now it's assessed for $98,000, and you're looking at buying it for $600,000. It can throw off that percentage because the 1% is pretty accurate. Most of the things that get you from 1% to 1 1/4 or somewhere in that range are flat dollar amounts. Like there's a school bond that's $200 a house. There's a water district that assesses $187, and they all add up. So some of those are not a percentage basis. They don't go up as the home value goes up. I have a tool in California that we use through Fidelity Title that gives us a tax estimate where it kind of does all the math for us.
There you go. So to simplify the response here, Tom, is it's not easy. But go Riverside has their property taxes online as well. You can go in, put in specific addresses and get the actual effective tax rate. And then you can multiply it by whatever price on the property, divide it by 12 and figure out what that, you know, is, or more importantly, just multiply it by about 0.1, 0.125, somewhere in that ballpark, or 1.1, 1.125. And, you can get that, get a better idea of what that actual tax rate is. All right, Josh. Heather got back and said she wasn't agreeing with you. She was agreeing
with me.
She said that you just haven't responded to her, just like the other client. So, Josh, this is becoming a problem. I think we need to vote right now. Another vote. 1, if Josh should stick around and continue to be the lender of choice, or if 2, Josh is too busy and we need a new lender. Just let us know. 1 or 2. I think this is a vote everyone should participate in. And see, now he's even typing in my name on here. He's going in and putting my information. See, this is illegal, Josh. You're acting on my behalf now.
I'm impersonating you. Absolutely.
This is a problem. All right.
Tom's on Team Josh, so he said, bite it.
I don't know what's going on here.
Yeah.
Are any of your first-time home buyers able to purchase fixers, or all of those being scooped up by flippers, cash buyers? So most fixers in our market are being purchased by investors. I'm not seeing it's hard to say because a lot of the true flips, right, never hit the market. A lot of them are sold off market before they ever come on. But with that said, the ones that do hit the market, even those most times are being scooped by investors because they have the cash, the ability to close quickly. And that's typically what these people are looking for. But what I can tell you is if you have the down payment or the cash ready, typically speaking, as a first-time home buyer, you can pay more than an investor is willing to pay because you're not trying to build in that profit. You're not trying to build in that margin like an investor would be. So, but the caveat for most first-time home buyers is they don't have those deep pockets.
Well, Jeb, let's talk about that margin, at least for us in Huntington Beach, because we've seen at least 3 examples. You're going to use the example of the one that we wanted to buy that you ended up selling and the margin they ended up at. A house at the end of my street sold for $1,750,000, which you're like, okay, it's a big house, big lot that people would love. Very dated. I'm like, well, okay, 1,750,000, that's not a bad number for that. They did a complete renovation, not much exterior wise, but the inside, everything that you can touch is brand new and beautiful. They're back on the market for 2.1 million. So you're like, it's a $350,000 margin. I look at that, that's $200,000 minimum of work, even if you're a contractor. So you're doing it yourself, there's no markup. I'm not tying up $2.1 million or $1.9 million, $2 million for the chance to make $70,000, $80,000, $100,000. I don't know if it was the same group, but like the next street over, another really big house in my neighborhood, they had a bigger spread on that one. I think they got it for 1.6 and they're back on the market at like 2.3. Those margins are really thin. And because the prices are so high, the carrying costs are huge. And if you end up under budgeting for your repairs, carrying it too long, or not getting the price you think, I don't think it's very hard for these flippers to get themselves on the wrong side of it in the current market.
I don't disagree with that. I think there will be some upset investors here over the next couple of months to a year that are paying too much and seeing a market that's not appreciating like it was. All right. Is there a good rule of thumb, Josh, to estimate for an interior remodel in SoCal?
I'm the wrong one to ask. At one point in time, I could have told you, but the numbers that we were paying in 2010, 2011, 2012 are so comical now relative to what things cost that it would be woefully inadequate.
There you go. Yeah, I don't really have one either. I mean, it depends on the finishes, right? That's really what it comes down to. Are you moving walls? Like, how extensive of a remodel are you doing? Are you talking windows, roof, HVAC, like everything? Or are you just talking basic cosmetic remodel? Because there's big differences between the two. And I think, that's essentially what you got to nail down is what you're spending. Because some of these remodels, I mean, I think like a basic remodel now on a flip property, 1,200, 1,300 square foot home. Like a lot of these are $150,000 remodels and probably minimum. It's not fancy. It's just pretty basic in what's going on in these things.
Yeah, the numbers are a little bit bonkers. So the margins are the spreads between purchase and resale. The carrying costs are super high, astronomical. So tell us a little bit, Jeb, about that one that you did. Did that person end up paying cash that you sold, the contractor that did the flip? Did they pay cash or did they finance that one?
Which one are we? I don't remember which one we're talking about.
Off of Beach Boulevard, Beach in Indianapolis.
Oh, that was a cash purchase. Yeah, so they came in with cash.
So
they might have gotten hard money after the fact, but yeah, it was
if
cash.
You pay cash, your carrying costs are really small. If you're a contractor, this price 100, 150 a square foot. There's no way that house on my block is 20, just a hair under 2,800 square feet. Pay 100 a foot, that's 280,000. You're at 2,030,000 and they're asking 2.1 million. So there's no way they paid 100 a foot. So I don't know. Are there contractors out there that can just be super tight and they're just paying their subs? Because if they went much over $200,000, they're out of their minds because they're not going to get their money back out of that house.
And it's crazy is like some of these flips, man, are coming back on the market in 2 months. Like from the time it closes, it's already back on the market in 2 months. And I'm like, wow, like, I don't know if I'd want that flip just because of how quickly it moved along. But they're happening quickly. So the carrying cost is low on that sort of thing, but there's obviously a lot of risk. All right. Another question. How soon after you refinance, Josh, how soon after you purchase a home with a conventional loan, say 20% down, can you refinance?
For a rate and term refinance, you can do it immediately. There's waiting periods for cash out, and there's waiting periods for you having to want to use a new appraised value. And the funny thing is, we're doing so few cash out loans or people trying to use a new appraised value that I don't have the numbers up. I'd have to search them real quick. Either 6 or 12 months waiting period on both of those to be able to use assessed value and or to take cash out. But in terms of a rate and term, you do it a week later if you'd like to. Jeb did it.
I, I did a refinance before my first payment was ever due on the house that I bought in 23. Yeah, so we bought that house. It closed in November. My first payment was due January 1st, and by the time that first payment had come around, I had already refinanced and taken the payment down like $400.
He's never made a payment. He just refinances every month and just pushes it off.
That would be
that
would be fantastic. All right. Let's see what else we have here. Not a lot of questions. Now's the time, guys. If you have questions, put them in the chat. It's also a time that I want to ask if you are finding any value, make sure you hit that thumbs up. If you're one of those people that show up every week and you haven't subscribed, please do us a favor and do that. Helps the show, helps the algorithm, helps all of the good stuff that we need to see in order to kind of keep pushing along. And also, if you're somebody that's going through the process, I know we're helping a lot of people, Josh. In fact, I got emailed from somebody here while we're on the show, scheduled an appointment with me on my calendar Friday. You're already working with them. They have a realtor, but now they want to speak to me. So about potentially switching realtors. So we will have that conversation. But I know a lot of you guys are reaching out. JebSmith.net/start will get you in touch with me, get you in touch with Josh, and ultimately hopefully get you to the finish line. Helping a lot of people right now, and feeling very grateful for those of you that are trusting us. So thank you.
And I would say it's probably about 50-50 of the people that reach out. If you're over 7% on the conventional loan, probably makes sense to do something right now. If you're over 6.5 on FHA, VA, probably makes sense to do something now on a refi. So that's a lot of the activity since that jobs report coming down. So yeah, just know that we're happy to run through the numbers and set a strike rate. If it doesn't make sense today, we can just determine, hey, this is the number. If and when it gets there, we are good. So Jeb, Wesley's trying to get cute here. He's saying, so Jeb paid closing costs twice before he even made a payment. Jeb, did you pay 2 sets of closing costs before you ever made a payment?
I did not. First time, the first loan that I did purchase, paid a small amount of closing costs. Some point, like not even a point, I forget, a couple $1,000 on that loan in order to do it. And the second time I refinanced, I took a slightly higher rate. So the first time I got a 7% rate. The second time, the rate that I got was 6.5%, which at the time was slightly higher than the market rate at that time. I don't know if the market rate was 6.375 or just below 6.5. But anyway, there was enough lender credit there. My loan amount is a decent size. So, when you factor in, the little bit of yield spread there was enough there to cover the cost on the loan. So I didn't have to pay anything. So I took a slightly higher rate. Lender gave me a credit, paid for the cost. Same thing happened the second time I refinanced after that.
Hold your thought, because there's another question that you are answering right now. Vaj Chang says, Jeb, how much more interest does your lender add on for a no-cost refinance? So they're asking, what delta, what premium are you paying in the interest rate, and explain the difference. Yours is a large loan and why it's easier on a bigger loan versus a smaller loan.
Yeah, I think it's important to understand, like, rarely ever is a rate on a given day that rate with no credit or no cost, if that makes sense. I hope I'm explaining it the right way. So say, for example, the best interest rate you can get today for, your situation is 6.5%. Well, that 6.5% likely comes with a little bit of credit and or a little bit of cost, right? Every single day. Rarely ever is it 0.00. So on the day that I took that rate, I don't remember what the actual yield spread was coming off of it. I could look on my closing statement, but I took a 6.5%, and there was enough credit there, but on that 6.5 to cover my loan amount was $1 million, right? So if you got 0.5% or 0.5%, that's $5,000 that I would have gotten towards closing costs on that loan, which would,
and that's generally 1/8% in rate.
Right. So that's title, escrow, all of the closing costs on the loan. Now, I think because it was a bank, I had to pay like a $350 fee, some weird fee. Like, it was stupid. I didn't have to do an appraisal on the first one because I was so close to the actual closing on the thing. They didn't require an appraisal. So there were some things that weren't charged. There was a credit. I didn't have to pay anything. So it came out just net even on my part. And then the second time, similar situation, took a slightly higher interest rate, got a credit, covered the cost. We moved on. So,
Jeb, I think I have determined that Heather is your alter ego. I'm not sure how you're commenting here on the show while we're actually doing the show.
What does it say? I can't read.
She says, we should get Josh an assistant. He knows what he's talking about, but I think he just needs more help so he can delegate the workload. Jeb tells me this about 8 days a week and twice on Sundays.
Yes, I'm trying to get Josh to. Josh is very much a controlled. He wants control 100%, and I can't say I'm very much the same way. I've learned over time that to give some of that away. But I'm still the same, but I'm not the same. So Josh is worse. Josh needs to delegate more and allow people to do their version of his, whatever it is he's trying to accomplish. And not micromanage.
And then Jeb, Wesley's getting cute. He says, Infinity is my alter ego. You're funny, Wesley. You're funny.
That's so good. That's perfect. That's fantastic. All right. So let's see here. We had some questions. So we got a question here about a general contractor filing BK. What can you do? Not a lot.
Physical violence is always an option.
Yeah, I mean, you could take them to small claims court, but I mean, they got BK. What can you do? I mean, there's the potential that if you paid them money, maybe they still own property and they haven't filed. Maybe their house isn't part of the BK. You could file a lien, some sort of lis pendens on the property for anything that you owe. I mean, there are options depending on that contractor situation, but you probably need to get an attorney involved at this
point. Have an LLC or an S corp, so they don't have to file personal bankruptcy. The contract is with their corporation. Sure. So we are absolutely out of our depth talking about legal issues here.
Oh, 100%.
That's as much as we're capable of sharing.
Yeah, for sure. All right. JK came back in, says, not a question, but I normally work at this time, so I got to catch the live on replay. Appreciate the work and insight, fellas. So thank you for dropping by, giving us a chance to have a conversation. We appreciate it. We got a question here from Anoop. Says, how do assessors put a value to land? A 1,500 square foot house on a 6,000 square foot lot versus a comparable 1,500 square foot house on an 8,000 square foot lot in the same neighborhood. What would be the difference in value? Depends on where you're located, to be completely honest, right? It's not different assessors, different states look at this entirely different than other areas.
I speaking completely out of ignorance, my limited experience in dealing with county assessors throughout Orange and LA County leads me to not have a whole heck of a lot of faith in them. I think it could be automated largely because, as Jeb said, from area to area, city to city, state to state, very, very big differences. But even within the same neighborhood, we're just talking about that house at the end of my street. It's not the greatest location because it backs to a somewhat busy street, but it's also a park of a lot. So I don't think that the Orange County assessor has someone assigned to that goes, okay, we're going to look at it backs to Springdale, so we're going to take value off of it. Oh, but it's huge, so we're going to add value to it. They rarely know what the condition of the home is. So I don't know. I think it could be largely automated, but I don't put a whole lot of stock or faith in them being
It has accurate. To be automated. It has to be.
With someone just doing a review, right? Just someone automated, and then someone looks at it and goes, does this look right?
I don't even know if that's the case. I mean, like when we talk about properties, like for comparable purposes, for appraisal purposes, comp purposes, when we're listing a home, we're looking at, like you said, location. We're looking at the size of the lot, the square footage of the home, the condition of the home. But once you take the home out of the equation and you just have lot, I guess the better question is, I've never looked at this, but a lot backing to a major street versus a lot on an interior part of that neighborhood, are they giving that the same land value? My guess is probably, when in fact, those are not the same land value, right? I mean, one is definitely going to be worth more in theory than the other because of location, but I don't know that that's a piece of the puzzle, at least here locally.
Yeah.
So anyway,
well, they do crazy things. I think I've told this story on the show here before, Jeb. I bought a house that we flipped, and then less than a mile away, very similar neighborhood, both built in the 1950s. We bought a similar home. Both of them were off market. Both of them were trashed homes. Well, because it was off market, we basically showed them the first one, like, no, we bought this here. And then we bought another one, basically using that as the comp. And we bought them both directly from the sellers. Jeb, it was your Glen house. The Glen house, we had done one right around the corner from that. And they're like, no, it wasn't in the MLS. So we get to set the value on that. I'm like, oh, no, you don't. So we had to go and give them all of the pictures and show, basically we did their job to show them why it wasn't worth, and they still didn't assess it at what we paid for it. They still said it was worth more than what we paid for it.
All right. David says, how would you advise a potential seller if the home has signs of foundation issues? Independent engineer assessment first. Seems like the companies offering all-in services have misaligned incentives. Here's what I would say is, again, talk to a real estate agent in the market that you're in. Get a couple of, interview a couple of different agents in your market. Chances are they probably have an engineer, somebody that specializes in that sort of thing, that doesn't have a motive. Like some of the engineers I've used in the past are simply that, right? They're geo engineers, depending on where the house is located. They're there just to look at the structure of the property. They're not there to give you an estimate of the repair cost or any of that sort of thing. Because again, depending on what the structural issue is, it may be maybe not as big of an issue as what you're thinking. In some cases, maybe it's worse. But now that you have the bid or the information, now you have that and can talk to a couple of different people and get it bid out versus just coming in with one option from the person who did both sides and worrying about being able to trust their the information that they put on it. So I would say, non-biased opinion first, have that information, and then use that to shop signs of fixing the potential issue if it's something that is fixable or something that's worth fixing, just depending on the situation. So yeah, anyhow, should somebody buy now, Josh, or should they wait?
They should buy when it's the right time in their life, Jeb. Do you want to know how it's the right time in their life?
Yeah, I'd love to know that.
They're a stable job, career, they've saved some money, they have good credit, they're in a good relationship, or they're not in any relationship, so they can make the decision on their own. They don't have kids where life is going to be changing, things of that sort. If you've saved 20% and I didn't have an inheritance and I'm a financial misfit, saving 20% is one of those good signs that you're working your way there. Another way that we like to answer this question is basically just to say, wait for what? If you have the 20% and you're asking that question, it sounds like you would like to buy a home. The answer would generally be yes, but okay, what reason would we have for waiting? We've talked ad nauseum here on the show. Most parts of the country, we don't expect a big downturn in prices. Rates are likely to get better, but how quickly and how much is open to debate. Personal question. No one can tell you whether you should buy now or wait, but those are the things I would be going through in my head when I'm making that decision.
I think that's a good response. All right, guys. I got about 5 minutes until we exit here. Josh, if somebody makes one extra payment per year, how much are they saving on their interest? Obviously, it depends on the loan amount, but what does that translate into over
The
time?
quick and easy answer is go to ChatGPT and throw that in. It varies over time. There's not a rule of thumb. People like to say, oh, we'll make it into a 21-year loan. It depends. The higher interest rates are, the more valuable it is to prepay. The lower interest rates are, the less time it's going to cut off the loan. So with rates where they are right now, I could play with the numbers if we weren't answering other questions, but I'll bet you it would take somewhere around 7 years off of the repayment.
There you go. Good stuff. Josh, you know what I was thinking as you're saying that? We've actually had this conversation. We've done nothing with it. We should create our own GPT for the educated home buyer with years of video transcripts so that anybody could put any question in there and it gets answered by you and I.
We could absolutely do that. My worry or concern is just liability with the hallucinations. It could say crazy things and attribute it to you and I, Jeb, and we could be sued or on the wrong side of the law or possibly jailed.
Jailed. That sounds fun. Being jailed sounds fun. Josh, have you ever been in jail?
I have not. Have you?
I actually have. I have been in jail. Yes. I was in college.
So Jeb's apparently more fun than I am. I
was in college. Yes, it was a crazy night. I didn't stay there, but I was there for a period of time. So, and it all got dropped. But yeah. Anyhow,
Wesley said if you create this video GPT that can answer all of his questions, he would not show up to live streams anymore. So don't build
I mean,
that.
honestly, we wouldn't have to be here.
we wouldn't show up either, Wesley.
This is a win-win. You know, we don't have to be here.
We could all go pay attention to our fantasy football teams where we should be allocating our time.
Oh boy, here we are again. Let's see here. We've got these AI renders and listings are getting out of control. Are there any rules or guidelines against faking listing photos? You know, I don't know the answer to that, to be honest. I do know that people use fake backgrounds all the time in photos on the MLS through Photoshop, and there's other programs out there that allow you to do it. You know, the sunsets and the crazy stuff. I don't know what the stipulations are. Like, for example, on YouTube, if we use any AI in a video, whether it be, you know, Josh and I not actually being here, being someone else here, whatever, any AI at all, we have to mention it. YouTube has a strict policy on it. Whereas the MLS, there's nothing there for us to check box wise, whether there's AI, whether there's anything else. You know, you are supposed to let people know if there's virtual staging in photos, but that's not even to the public.
I don't think I've ever seen a notification that there was AI staging. You can tell when you know what to look for, but I don't think I've ever seen it.
There's some now. It's crazy. Like, I'm in some of these forums online where people post pictures, and I'm like, I had no idea that thing was virtually staged. I couldn't tell whether it was virtually staged or not. So it's getting pretty good. I don't think there's any requirements yet, but my guess is it's probably coming, especially if you're changing anything on the property that's not there, or adding things in that, or adding things in it that aren't there, or removing things that are there, because
removing the dead body so you don't have to disclose the death on the property.
You know, that's one way to go about it. Or you could just take them out. They shouldn't probably be there anymore.
Probably shouldn't be there when you're doing photos.
Yeah, I watched the Dateline the other night, Josh, where they took her out and they just stuck her under like a tarp in the front of the house.
And they thought no one would notice what was going on under the tarp?
I guess. I was, and the best part is the whole house was wired with security cameras. So they had it all on video, the whole thing.
That's awesome. My wife and I listened to one that the guy took his wife, and where he used to like to go hunting, there was a big hole out in the woods, like 50 feet deep. And he put her in the hole. But the problem was, everyone that he had ever gone hunting with, he told them how much he liked this hole and how cool it was. And he would go out of his way to show it to him. So when the cops started asking his friends and family, like, where would he put a body if he killed someone? They said, oh, there's a hole out in the woods. And they went to the hole and they found the woman. And he goes, wasn't me.
I didn't do that. Somebody knew that was my hole, and they put her in there. All right, guys, if you found any value tonight, hit the thumbs up, hit that link below if we can help. Until next time, buy right, borrow smart, build wealth. Adios.
Amigos.